Good morning, everyone. My name is Oscar Parham. I am the manager of strategic operations at the New Jersey Redevelopment Authority, and I have the incredible fortune to be able to oversee the Training Institute. I want to first thank Ms. Leslie A. Anderson, our CEO and president at the New Jersey Redevelopment Authority. And I also want to make this announcement that we are going into our 16th year as of 2022. So we're really excited about that. We are at the NJRA very uniquely positioned to do what we do here and providing ourselves as a major educational resource in New Jersey. And as we say at NJRA, an educated community creates the foundation for a vibrant, prosperous, and sustainable community in New Jersey. I'd also like to give a warm thanks to our presenters today for their commitment to collaborate with NJRA to bring you today's webinar. Today we have the opportunity to bring you a webinar titled Real Estate Trends, Aligning Development Strategies Around the New Norm. Today's webinar will be in two sessions. In session one, you're going to hear what's happening as a byproduct of the pandemic in the real estate development space. You'll also have the opportunity to discover some of the current and emerging trends that are developing in the marketplace. Our experts will cover forecasts, supply and demand, physical design changes and amenities, and conclude with insights and strategies in the affordable housing market. In session two, you will hear projected changes in the current and emerging trends in real estate finance. As it relates to debt and equity financing, we'll also discuss tax credits, public subsidies in real estate and redevelopment projects. Our experts in both sessions will share with you their insights and how they are navigating the dynamic and complex forces that shape real estate development in New Jersey. At the end of our speaker presentations, we will have time for Q&A sessions. We'll also be inclusive of the chat questions that we will be receiving. And our moderator today for both of our sessions is Mr. Daryl Godfrey, who is our Chief Operations Officer. So at this time, I'd like to introduce Mr. Daryl Godfrey, and I'd like him to give you a brief introduction about himself, welcome our attendees, and Daryl, it's all yours.
Welcome, everyone, and good morning. Thanks for that great opportunity, Oscar, Mr. Parham. We at the NJRA are ecstatic about today, primarily because it's an opportunity for us to talk about not only what we do, but help provide some insights to what's going on in the real estate market today. As everyone knows, COVID has thrown us a different spin, but the real estate market has been very vibrant. So as Oscar said, I'm Daryl Godfrey, Chief Operating Officer for the NJRA. And I've been here for 7 years, going on 8. It's been a great ride under the leadership of Ms. Leslie Anderson, but also to meet with the great panel we have here today. So I'm not going to talk too much what I do. I know most people on the panel and listening to this webinar know me, and I welcome you for joining us today. I would like to just move forward and just talk about our tremendous speakers we have here today. Mr. Eric Dobson from the Fair Share Housing Center, Art LaFont, Integral Realty Resources, Michael Donovan, Haley Donovan Architects, Richard Rinaldi, Riverman Realty Advisors, Leela Martin, CREA, Don Engler, Goldman Sachs, Tom Slater, Investors Bank. So without any further ado, I would like to introduce Mr. Eric Dobson.
Thank you. Thank you all thank you, Daryl. Thank you to NJRA and Leslie and her leadership there. Thank you for the opportunity to speak with you today. I'm just going to give a brief overview of where we are, and I think the gentleman besides me can give you more information about what's happening in the real estate market. And I'm going to make a bold statement and a bold argument that I think one of the reasons why New Jersey have done better than other states around development is because of the Mount Laurel Doctrine. And I say that because back in 2000 and 2015, between 2000 and 2015, we had a shortage of housing, approximately about a 15-year period where housing wasn't being developed in New Jersey. So during that time period, there was a need for about 300,000 homes in New Jersey that wasn't being developed. The 2015 Supreme Court case set in motion, which some of you may not be aware of, that had agreements between 350, discussions or opportunities for 350 towns to settle on inclusionary zoning, keeping in line with the Mount Laurel Doctrine. To date, Fair Share Housing Center have settled with 340 of those municipalities. 340 municipalities now have their fair share obligation. Many of some have started shovels in the ground, projects are being developed. So when COVID-19 hit, New Jersey was already in development phase. Now, when COVID-19 hit, it slowed down a little bit, but development was still going on. So out of that settlement, out of that Supreme Court case in 2015, set the stage for New Jersey to position itself to be moving forward with development. And i.e., if you look at states around the country, New Jersey have done fairly well, better than many states when it comes to its financial situation. So that's my initial stage in making a very bold statement. And there, I'll stop there and let everybody open up, and I'll get back into that discussion later today.
Reverend Dobson, bold is great. I think bold was gets us to the next level. So please, no apologies. We appreciate your candor. Art, it's on you now.
No sound. You're on mute.
You're on mute, Art.
Yeah, I'm sorry. A brief introduction. I'm a managing director here at Integra Realty Resources in Northern New Jersey. I'm also on the board of directors of Integra Realty Resources Corporate. As a practitioner, I hold the MAI designation for real estate appraisal and the CRE designation as a real estate counselor. We do a fair amount of redevelopment work in our practice. We analyze pilots, fiscal impacts on municipalities with regard to specific developments. And I also teach as an adjunct professor at Rutgers in the market analysis and valuation class for the business school and the Center for Real Estate. So basically, that's my bio for today.
Thanks, Art. Appreciate it. Michael Donovan.
Yes, hi.
How are you today?
Good. Thank you for having me.
You're welcome.
I'm the owner of Haley Donovan Architects. I've been so for 14 years. Prior to that, I worked for another firm specializing in affordable housing, and for 8 years. And before that, I did do some construction. So, I've seen that then and swung a hammer for a little bit, which really helped me know how things go together. And I'm going to be talking a little bit about post-COVID and how it's going to affect our built environment and trends.
Thank you, Michael. Look forward to you. Richard, how are you today?
Good morning, Darryl. How are you?
I'm doing well.
And thank you for the invite. I'm Rich Rinaldi, and I'm at River Main Realty. I'm a small boutique real estate advisory firm. I started out at what used to be Coldwell Banker Commercial. Today is CBRE. Back in 1986, I worked at CBRE and Grubb & Ellis, but then morphed into the development space, primarily because I'm, from the Jersey City, Hudson County waterfront market. I've been involved in a number of developments. Some of the topics today are going to be about TOD. I was involved with the TOD development at the Aberdeen train station in Aberdeen, New Jersey. I was involved with the West Side Station project in Jersey City. I was involved with the Georgetown Land project up in Connecticut. As a couple of examples, in brokerage, I was also involved with the Sugar House in Jersey City, the State Theater site, and I've kind of been in that space for a while. We tend to represent the smaller developer who needs what I call the belt and suspenders and the ability to be able to represent themselves appropriately in the market, managing everything from their pre-development responsibilities through to the capital finance and development. And I've been in a number of spaces, whether it's residential, We advised the developer that took over originally the Liberty Landing Marina in Jersey City, and I'm now even working on things such as affordable housing with Reverend Knight in Jersey City at Heavenly Temple. So that's kind of my background.
Well, thank all of you gentlemen for giving a brief synopsis of all the wealth of information and skill sets that you bring to today's conversation. I will now pass it over to Renitra, who has a couple of things for you guys to talk about for your particular industry experts.
So good morning. I think that my presentation here is just going to be a general overview of the real estate markets. And that can be these days a very lengthy discussion given what's going on. But I'm going to try to touch on the 4 food groups and maybe talk a little bit about the most interesting food group, I think, which is the industrial market. But let's start a little bit about what's happening. The COVID-19 situation, in our opinion, accelerated what were trends that were already in place. Work at home was already something that was being discussed. Online shopping certainly was something that was growing. And COVID-19 really accelerated the acceptance of those 2 items. I mean, it got to the point where my parents were ordering things online, and they're 87 and 88. So once they get comfortable with the computer, I think the rest of the world follows. So COVID forced people and business owners to do things they might not have been ready to do or found the need to do at any time in the near future. COVID made you do it and do it now. So employers were forced to deal with at home and distance working, and people were really forced to order things online as shopping centers and malls and so forth were closed. So it really did accelerate a pre-existing condition to a very high degree. So with that in mind, let's talk a little bit about these 4 food groups. Multifamily, while took a little bit of a step back with COVID, is very robust. Cap rates are very low, values are high, rents are going up, and demand, at least in our suburban markets, is very high. There is somewhat of a reversal in trend of what we were told about, people moving towards the urban areas and away from the suburban areas. Well, people are kind of moving back to the suburban areas now. And again, that was a trend that started probably in 2016, but it was again accelerated by COVID. So multifamily, very good asset class in high demand. Office is probably the most uncertain market with the work at home issue. What's that going to do for office space demand? I hear that brokers, when COVID began to lift a little bit, were extremely busy leasing up space, but it wasn't necessarily space that was being absorbed. It was tenants that were renegotiating the leases they already had. And either they would stay in the same amount of space or they were reducing their space by about 20%. It's very industry specific. I know we just negotiated a lease for our office, and we went from 5,100 square feet down to 3,300 square feet, following the very same trend I just put out there for you. So it still is somewhat of an unknown what's going to happen with the office market, but I think the general consensus is there is going to be a surplus of space for a while. There are turnarounds taking places. Some of the well-positioned or well-located Class B office buildings are getting renovated into Class A office buildings and getting very high rents. Other buildings are not doing as well. And again, it's very location specific and it's very product specific. So if the building lends itself to a good turnaround, that'll happen. So office parks are trying to reposition themselves with mixed uses. In Hanover Township in Morris County, instead of Matt Cali building another 1 million square feet of office space, they had the entire tract that they owned redeveloped with a Wegmans, a Panera's, a 24-hour fitness, which is now an LA Fitness, and several other retail uses, a Capitol Grill and Seasons 52 restaurant. So some of the office parks, which were at one point the model for the country, the New Jersey model was the model for the country, is now being reconfigured to more of a mixed use type of development. With as far as retail is concerned, the malls are getting mauled. It's as simple as that. And the biggest issue with the malls really is the condition of the anchor stores. The anchors were called anchors for that very reason. They stabilized malls. They did all the necessary demographic studies to test the strength of the malls. And if those companies were willing to invest and locate in an area, well, then your interior mall would fill up for those very same reasons. They would just follow where those anchors went. Well, those anchors are now in serious trouble. J.C. Penney's is bankrupt. Lord & Taylor is closed. Sears has been closed for quite some time. And it's creating a very serious problem for the malls. So what we do find, even the strong malls, which I believe will always be strong, Short Hills Mall, Garden State Plaza, they'll always be strong. Almost everyone has a redevelopment plan. Almost everyone is going to reposition itself. Garden State Plaza, which I think is the number 2 largest mall in the state and the number 17 in the country, has a massive redevelopment plan to create all sorts of mixed uses and things of that nature. So I would watch and see what's going on with the mall industry. It's going to be a real dynamic change, and we may see a number of malls disappear that we might not have thought about before. Cap rates can be as high as 18 or 20% if they stay as malls, and they may not. What really is interesting about retail is that grocery-centered shopping centers are in very high demand. Even standalone grocery stores are in very high demand, and you'll see cap rates go down as low as 5%. But good mixed malls with a grocery anchor could sell at around 6%. So they are still a very sought after asset. So the malls in the retail area are somewhat in flux, but I would watch what goes on with the malls. It's going to be a very interesting transition. The last group I'd like to talk about is the industrial market. And in my 25 or 30 years of doing this, I've never seen such a dramatic shift in, I'm going to say, use. Industrial has always been, warehousing and whatever they were warehousing, whether it was copiers or goods and services, whatever it might be. Now, all of a sudden, the industrial is becoming the new retail. We see buildings being built all up and down the Turnpike Corridor, all around 287, 78, every major highway that we can find in New Jersey is being developed with industrial. The numbers are staggeringly high. It used to be that the industrial space would rent for $4, $5, $6, $7 a foot. Well, it's going to go as high as 20. It has reached that in some markets. Pretty much we're seeing numbers in the $15, $16 a square foot range, $13 a square foot range, and compounding that growth in rent, which is somewhere in the neighborhood of 10 to 20 to 30% in some markets over the course of the year, is the fact that capitalization rates are dropping at numbers that are difficult to comprehend. Typically, cap rates might be in the 6 or 7% range. Well, now they're in the 3s, below 3, 4%, 4.5%, and it's driving values to incredibly high numbers. We're seeing sales from $250 a square foot to $400 a square foot. We're seeing land values at enormous numbers because of these trends in cap rates and rents. It really is a use class shift. The dynamics and the affordability of these rents has a lot to do with how much product can be sold out of a particular location. So it almost does become a pseudo retail type use. It is a market that's growing to a huge degree, and where that's going to end, who knows? I was asked down at the League of Municipalities at a presentation we did whether or not we're in a bubble. Well, that's a very good question. And we talked a little bit about that offline before. And interest rates are historically low. So when interest rates go up, sometimes bubbles burst. Are we in a bubble? I'm not sure. We'll have to see how stable the interest rate environment is and how strong the demand might be for redevelopments and developments of pretty highly sought after assets like multifamily and industrial. So real quick, that's where I'm seeing the market going. I hope put a couple of questions out there in your mind that you might want to ask in a few minutes. And with that, I will release it back to our presenter.
Richard,
I'm up. Okay.
you are.
All right. I guess I'm Art's cleanup because Art took a big part of what's happening in the market today. So I'm going to try and compliment what Art gave because I think we're interrelated anyway. One of the things Art talked about was the transition of space, and I think all we're really seeing in the market right now is a transition from office space to home space. What we're not using in the offices, we're using at home. So home use is becoming bigger. People who had homes or apartments or condos that were not necessarily set up for their businesses are now being used as such because people are working at home. So if we're losing X amount of square feet of office space, it's probably transitioning into our residential use. And having said that, I think that really what we're seeing in the residential market is really the MSA that we're dealing with as it relates to the metropolitan statistic area. You know, we have a 20 million plus population in this MSA, and it's just floating from different areas of the market, whether it be from Manhattan and the boroughs to Connecticut to northern New Jersey to Westchester to South Jersey. It's just expanding in general. And so as a result, that's why we're seeing the push. I don't know that we're necessarily seeing it going from the urban to suburban areas. I just think it's about the musical chairs, and every musical chair is being either filled or open to be refilled to be moved somewhere else. The problem with that becomes, as we have this transition, we have a shortage of, I don't like to call it affordable housing. I like to call it housing that's affordable. I've used that term for a long time. I wish they could use it more often because I think people give the term affordable housing a improper connotation. So I'd rather call it housing that's affordable. And when you start talking about the market and hearing that homes are selling for, 10, 15, 20% above ask because our interest rate floats allow people their cost of occupancy to be more attractive at a cheaper interest rate, it makes pricing more difficult for those that want housing that's affordable. But that's what I see. I see a transition in space from the office space to the residential space. And I do agree with the Reverend that we are moving in the right direction. The issue that we're always going to have with affordable housing is pricing and gap filling on equity to ensure that we can make these projects profitable. I'm not the best person to talk about the new Aspire program or the 4%, 9% credit programs. I think I'll leave that to the Reverend if he's comfortable with it. But I do know that that type of financing is imperative to create the opportunities that are available. I'm happy that the state of New Jersey has created the Aspire program because it's making the affordable housing market excited about building affordable housing, or as I say, housing that's affordable. As it relates to the industrial, I agree with Art. I mean, industrial is now at a point where it's amazing, but I think it's a function of two things. It's the e-commerce that Art talked about as far as people using the internet. We went from going to stores to doing it on the internet. So that was changed from you buying it at a store to you having it delivered to your home. So the distribution of those e-commerce sales have to be managed somewhere by someone. We all know that Amazon took upwards of 4 million plus square feet of space. And on top of that, the e-commerce delivers of every other opportunity in the market are also growing. And that's buying much of the available dirt in industrial areas, which is becoming competition for those people who want to expand as developers the mixed use projects. So that goes to the point of, at some point, we're going to have to morph the changes of uses. And again, it goes to Art's point, we're going to start to see changes of uses in retail. Not only is Garden State, does it have a master plan, but I know in Hudson County, both big malls that are in the Jersey City area, the Newport Mall and the Hudson Mall, both have master plans as well for redevelopment. In fact, I think Jersey City's intent between the Hudson Mall and the Bayfront project is to build about 17 to 20,000 units with mixed-use retail and commercial. So I see all of that happening. We're just transitioning space and use from one type to another. The one thing that I do see is we're going to have a problem, or we have a potential problem with both materials and labor. Materials are at a short. We shut down for a period of time during COVID. We stopped manufacturing. We stopped cutting trees. We stopped doing the things that we needed to do to keep the supply chain moving. And those shortages are going to create issues. I think it'll just create timing issues. Things will get pushed out a little bit longer. Financing requirements will take a little bit longer. And construction phases may take longer just so they can match the timing of available inventory and materials to the timing of construction. Basically, going back to it, what we're going to see in these mixed-use developments are going to be the everyday retail is going to be more attractive. Downtowns are doing better than ever because it's everyday retail. It's something that we can't do on the internet or don't want to. And so therefore we wind up using our local retailer for those products. That's what I have for now, and look forward to chatting more.
Thanks, Richard. So housing that it's affordable, I like that one. I think that's going to catch on. I guess we can put up the presentation. I think that would be helpful. Something to look at while I'm talking. Just this new normal and talking about how it's affecting housing. Housing and shelter were always an important basic need. But during this pandemic, when we're spending a majority of our day at our home /office /school, a decent place to live is all that more important. And if you're living in a large suburban home and you have a large yard to escape to, that's one struggle. But if you're in a small apartment and you're spending an exorbitant amount of time in an apartment, it is untenable. So, the cabin fever, like we see in the movie Shining. So that didn't end well. And so what we need now in post-pandemic, the lessons we learned, we need some outdoor space, at minimum, a large deck, large amounts of daylights, looking out the landscaping. We know what that does for the mental health of people. We need places, and to work virtually, we need a high-speed internet. We're all fortunate enough to be on this Zoom call, and you need high-speed internet, and that should be something that everybody has available to them. So a building-wide Wi-Fi in affordable housing, I think, is a trend we're going to see more and more of. We need places to work. So spaces within the apartment, built-in cabinetry to do remote work at home. Even a little small nook private office where you could retreat to. I know units are starting to get smaller and smaller, that micro unit, and projects are needing to be more density to become financially feasible. So the trends have been to smaller and smaller units. And now after COVID hit, I'm wondering if that's going to change. And people need a little bit more space if they're going to spend that much time in their apartments or their place they call home. So, and then also in conjunction with that, I think this is brought about, people always had a desire of life-work balance. And I think this generation, it's even more important. And after they worked from home for a short amount of time, it's becoming a priority. So I think that trend is not going anywhere. People are going to work from home, and we need to accommodate that and make, employers are going to be starting to allow, maybe partial work at home, partial. It's tough in our profession to be fully at home the way we communicate so well, but we're working those things out, and I think that's a trend that's not going anywhere. There was a Grim Parker report that says with projected success of work from home business models, residents need their units to become more versatile, adaptable to provide users with enhanced technology, spatial flexibility, and separation, as well as adequate mental relief through the connection to outdoor environment, which I think is right on point. Some of the trends, whether it's COVID related or not, we're seeing the mail centers are becoming much more sophisticated and require more planning and to work well. Package lockers, the typical post boxes aren't enough. We're getting large deliveries. We're even getting groceries at home. So that is coming to the forefront and is an amenity that many we need to address in the apartment living in the future. This I don't think is directly related to COVID, but we're seeing more and more developers are opting for 9-foot ceilings. It has a profound effect on how the apartments perceive the spatial. It just adds so much space to the unit. Charging stations for cars. We're seeing that particularly in market rate deals becoming more and more, a requirement, and more of them. Electric cars are becoming more affordable, and we need a place to charge them. So that's another trend that's and as the green movement, and we make buildings tighter and tighter. There's the air leakage, the air changes per hour have gotten down to crazy levels, and that helps with the energy consumption tremendously. But we need fresh air, so we need to introduce fresh air to the building, filtered fresh air. Many of my projects we're seeing an ERV being introduced to distribute fresh air to each room and to recover some of that exhaust, and intake, temper it before it hits our space. I think this was always a trend, but it's even becoming more and more important, is a large fitness area with social distancing in mind. A lobby space, we're finding a trend where it's not just a community room that's just a separate room. It's part of the lobby. It feels like it's you don't have to enter a separate room. That helps even with touchless entry and spread of even the common cold. But that people are becoming more and more aware of touching things and stuff like that. So we want touchless entry and spaces that just flow openly, and you could see that in the current exhibit we have up. That community room is like it almost feels like a cafe where you could flow in and out. There's workstations for the community to use the computers, and then hopefully the pandemic in the near future is contained, and we have learned some lessons from this historic crisis, and we're prepared for the next time something like this happens. And perhaps it reevaluates our perspectives on what we need from a home and what we need from a family. And I think that's, people have really put a higher value on family during this. Maybe that's a good thing that came from this. So going through a few of these slides showing the fitness area. If we can go back on a few slides to the beginning. I'm sorry, I was just rambling on. I wasn't really paying attention. Okay, so yeah, this is a project, a mixed-use building we're doing in Camden, and the ground floor is going to be office. To the right is office, all 4 floors, and then there's 24 apartments to the left there. And you could just see here the outdoor spaces, how important that is. There's a daytime and a nighttime view of that. This should break ground very shortly, in about 3 months. Next slide. So then this was the first project we were really able to incorporate some of the things we learned from COVID. We have small office nook. We have a large outdoor space. We're just trying to make the apartment more flexible because we're spending so much time there. it becomes the office, the like school, and like I was saying earlier. So we're trying to push more and more. A recent trend would be like a Juliet balcony. We're trying to get a full size balcony here so people can get some relief, get some outdoors time. The next slide. That's just showing some of the amenities and the recent trends. We have a bigger mail area now near the lobby. Community room is multi-purpose. We have a little cafe and a large fitness area there. And then the rest is commercial and retail. Going to the next slide. That's just the community room itself. It just flows openly to the lobby. We have games. We have places to use a computer. And then this is showing just a fitness center. We want our fitness centers to become more and more sophisticated, not just like a couple of treadmills. And then this is just showing the importance of outdoor space. Even this is particularly for the office portion of it, but outdoor space and getting some time outdoors and providing spaces to do so is critical now. And then this is just showing a little bit of Haley Donovan's work throughout. This is a project we're working on in Philly. And then the next slide is an office building we're working in Ship Bottom, New Jersey. Just to show a little bit of what my team here does. And I really appreciate my team, and thank you for having me. I think that might be it.
Thank you, gentlemen. I think you all summed up what I think is important in terms of how we look at design trends and workspace. I'm just going to talk a little bit more about the trend for the need of more, to use Richard's term, housing that's affordable and the opportunities that present. I think, as Michael talked about in his last presentation, the creativity around building sustainable housing that's affordable, units that's affordable is there. I think it's always been there. And we see the trends in New Jersey's population growth. It is sparked by the need for folks wanting, because New Jersey is comprised of two major metropolitan areas. In the northern region, you have one of the largest metropolitan regions in the country, and in southern New Jersey, you have the other metropolitan region and the Philly, South Jersey market. So the demand is always going to be there for New Jersey. And I think to the point that our other presentation, Richard mentioned that. And I think it's important for us to know that human beings aren't static. We move around. We move between urban and suburban and rural communities. Richard mentioned musical chairs. So the opportunity for development, particularly in this climate right now and COVID, is there. And I think one of the things that I want to talk about is making sure that the resources that the state has, and we're all waiting to see what happens with Build Back Better, but also with the State Aspire program and additional resources that the state have for American Rescue Plan. I think developers need to be really seeking and pushing the administration to really make that investment more into housing that's affordable, because I think that's important for New Jersey to remain. As you see, New Jersey has one of the highest real estate markets, and it is one of the wealthiest states in the nation. And those trends haven't changed, and is only exacerbating the wealth gap in New Jersey, as well as addressing the displacement that has happened because of gentrification in our urban regions. Now, I agree with Richard that there was some trend during some time that there was a lot of growth in the suburbs, and I think the suburbs is always going to be there, but we do see trends that are really encroaching on the urban market. Folks are coming back to the urban market, and I think that's only going to get, in my opinion, it's only going to happen more. Folks are going to going to be looking to have those downtowns and want to have that space. And some of the things that Donovan just spoke about, is the building that he's doing in Camden. People are looking for that city vibe, and not to discount that folks do want to live in services. That's fine. But I think it's important as we look at why New Jersey's need is so great around housing that's affordable, as I mentioned in my open statement, because we have underproduced over 300,000 units of housing that's affordable in that 15-year period where municipalities weren't active and the state wasn't enforcing the Mount Laurel Doctrine. And so from 2015, we saw this growth in development. And quite frankly, the numbers that we projected during this court case, you know, our e-consultant had some numbers, David Kinsey had some numbers, and Fair Share Housing Center had some numbers. And there was really debate about, you know, was our numbers too long in terms of numbers for units for housing that's affordable. And ironically, the census data came out 2020, and we're still waiting for more data to come out, that all of us was wrong. E-Consult was wrong. David Kinsey was wrong. And don't tell David Kinsey I said that. And Fair Share Housing Center was wrong. Our numbers was too low. All of the numbers were too low. Projections now is that there is a greater need because of the population growth in New Jersey, because of the expanded growth from different parts of the country, that there is a need for more housing that's affordable housing in New Jersey. And this is a population that I think we can't forget, because in our estimation or our opinion, housing should and is a human right. And we need to really not just look at the trends as Donovan talked about, how to mitigate or how to address some of the things that are in need when people are looking for housing, rental housing, or home ownership. The things that are in need, the things that people are demanding, the things that help stabilize healthy communities, and a lot of it has to do with mental health, open spaces, as Donovan talked about, green spaces, terrace, community spaces, because we are human beings. We need human contact. COVID-19 has made that a challenge, but we also are the most creative species on the face of the earth. Some may question that, but so we can be creative in how we design, build opportunities, density, because the opportunity is there in New Jersey. As Art talked about early on, there is a transition and that is happening, and trends that he so rightly pointed out that was already trending before COVID-19. People were online shopping. I know my kids and my wife online shop all the time, and that was happening before COVID-19. We saw the malls starting to, particularly in New Jersey, you know, the strip malls starts to lose its customers and lose clientele. Those can be repurposed. That's the argument that Fair Share Housing Center has always made when towns say they don't have space or they don't have the opportunity to build housing that's affordable. You have strip malls that are empty, office spaces are empty. Repurposing these things for the most important part of being a human being is providing shelter. And I think we forget that the most significant investment that we can make in this country and in the state of New Jersey is investing in people, investing in folks that need housing that's affordable. Veterans, those are special needs, those are low income folks, those are seniors. And we can't forget that. We have to keep New Jersey's seniors in New Jersey. We have to provide housing for special needs. We have to provide housing for those at the 80% and below area median income, and even down to the 30%, because we know that cost has skyrocketed. Folks' salaries, for instance, over the last 15 to 20 years haven't increased as much as the rents and the housing costs have increased. So we have an opportunity in New Jersey to address this, because we are situated and we have created, because of what I said early on in Mount Laurel Doctrine, the enforcements from 2015 on have already started before COVID, shovels in the ground and opportunities for development and growth in New Jersey has been steadily. So I think, it's important for us as a state, as developers, as folks who are looking for planning, for your planning departments, land use development is all. And I said this yesterday, I was on land use planning, that we all must be concerned about the human crisis of not having enough housing that's affordable, and not enough housing to house individuals or human beings in our state. And that requires us to make a significant investment. And I'm going to say this again, that requires us to make a significant investment into housing, particularly housing that's affordable or affordable housing. So we know, as I stated, the trends are there, that their population growth in New Jersey has increased more than the experts has anticipated. I think that was all just mumbo jumbo anyway. That was, I think a moving company put out the notion that people were leaving New Jersey, and people went crazy about that. Well, the problem is the moving company has an incentive to say stuff like that. So I never bought that for 1 minute, that people were fleeing New Jersey. That hasn't been the case for the last 20 years. So the trend is that population growth is on the upclimb. So we have to keep pace in order to keep New Jersey affordable, to produce enough housing that's affordable. And that takes a significant investment. That takes opportunity to put investing in affordable housing trust fund. That takes investing into developers who need resources to deal with the tax credit numbers. Yes, that is an issue. We need more money in tax credit development. So we need, NJRA needs more money to help fund some of these projects in our urban areas, particularly for minority, or let me say Black and Latino developers who are looking to get access to capital. Because I think Art mentioned this, or all of you might have said this, development is based upon financing. If you can get the capital, you can get the financing, you can get a project done. So I will urge all of you and everyone here to advocate, not just from the national level, because we're not sure what's going to happen with Build Back Better. We hope that it gets passed through, but also from what the American Rescue Plan and what the state has in its coffers as opportunity to really fund to keep New Jersey affordable. Again, our urban regions we are seeing displacement among our Black and brown communities because of the influx of folks wanting to move back into our urban regions. So we need to make investments in those urban regions to make sure folks can stay, long-time residents who have been there and who have suffered, and now the community is on the uptick. So yes, we need more diversity of incomes in our urban regions, and we have to make sure there is money and investment there to do that. Yes, we need more. And listen, development is happening. We had 300, and Fair Share Housing Center has 340 settlement agreements with towns throughout the suburban area, all of New Jersey. And towns are developing, and they need more money to help with the tax credit development. So that's my urge, that's my push today, is to really focus on investing in people. And that's something that I think is important when we talk about investing for development. Don't forget, we're talking about investing in people. It's not just buildings. Buildings can become vacant, but it's really making a significant investment in people and making sure people have shelter and clean water, clean, safe, and decent neighborhoods, open space, as Donovan talking about, space for work out, to be healthy, space for communities that have shopping, food markets there, not food deserts, as Art mentioned. And so that's what I want to say. I do applaud NJRA and his work that is doing. I want to applaud the three gentlemen that I'm on the panel with that is being at the forefront of doing this work and doing some creative design and creative ideas. I want to applaud all the developers out there that's creatively looking at ways to incorporate some of the needs that people have in your development, open space, technology, and terrace and balconies and green space, green roof, using that ability, because we know in climate change, suburban communities have a larger footprint in climate change than more densely populated communities. So, and I'm not against the suburbs. I'm just saying that it is important for us to keep that in consideration. So, thank you very much for this time.
Thank you. Thank you for your impactful presentations in the various sectors to give our registrants today I think, a nice broad overview of what's occurring within the real estate market from a development standpoint, the trends. And at this time, we've got a few minutes, and I'd like to present a few Q&A questions from our participants today. We've got quite a few. I'm looking here, so I'm just going to kind of pick and choose at random, and feel free, gentlemen, to jump in and give us your feedback. One of the questions I'm actually looking at says, with anticipated labor shortage and supply chain issues continuing in 2022, what strategies do you foresee small businesses and developers implementing to minimize the impact it will have on their business? That's a big one. All right, you want to tackle that?
That's a great question. You know, some of these questions. I mean, it's a very interesting question, and if you just follow your everyday life just to see how it's impacting you, how much longer are we waiting at a restaurant to get a meal? How many restaurants have empty tables but they're not sitting you? I was at one the other day, and they said, "Listen, you know, we don't have any room for you." I'm like, "But there's 5 empty tables." So they said, "Well, we just don't have anybody to serve you. You have to wait for a long time." So I think I think until there's some incentive to get people to participate back in the labor force, we're going to have these problems for a while. The supply chain issue has many different facets to it. How those are going to be resolved, I think, is a little bit beyond my pay grade. But automobile dealers still don't have cars on their lots. Retailers don't have as much on their shelves as they used to. You do see spurts of big deliveries coming every so often. But I think this is an issue that we're going to have to live with for quite some time until some of this infrastructure kind of breaks loose, and we do have a little bit more of an ability to produce goods and get goods on the shelf.
Wonderful. Thank you. I appreciate it. Anyone else want to weigh in on that question? Any other thoughts?
Yeah, I think it's really important to made in America. You know, I think that's, if we could start producing things and not rely so heavily on imports. That's not a short-term answer, but I think in the long term, we need to start, you know, handling it here.
Wonderful. Let me dive into another question. I've got another question here saying, let's see what we got here. Oh, here's a good one. What do you think the Build Back Better bill, if passed, will have on real estate development market in New Jersey, especially as it relates to climate change and affordable housing?
I particularly think that there's going to be more opportunities for affordable housing, which is great, and more focus on the environment and building incentives to build a more efficient home and use less energy. I think there's just going to be some positive effects from it.
And Michael, I think I've got another one here for you. It says, what multifamily amenities should we expect to be in demand? I think you spoke a little bit about that in your presentation, but what will be out of favor in 2022 due to the COVID pandemic?
I think so maybe those community rooms, gathering people being concerned about large gatherings and stuff like that. Maybe there's a little bit less of that, you know, and more focused on, like I said, the outdoor amenities and be able to get outdoors.
And we've got time for just one more question. This is a really good
question.
If I could just, Oscar, add to that.
Weigh in.
We just did a tour of a facility that's just brand new construction, and the apartment it's an apartment building, and they're beginning to look more like hotels. They actually have very large business centers in them to accommodate the work at home. And I was just wondering if you're designing things, you're being asked to design things in that way as well.
That is a trend, and I think people are willing to rent. You know, if they're working from home and they want to get out of their unit and they could still be in that same building and rent a small office. That's going to become more and more a trend.
Well, that goes back to my point. I said we're losing office space, and residential spaces are growing, and I really just think it's a transition. And companies are probably happy, right? Because now they have to lease less space. They have less overhead as far as leasing costs, because the lease space is really you paying for it at home versus them paying for it in an office. So I think the more you make the home, both the opportunity, or the apartment rather, I should say, the opportunity to work and have an apartment that's full service, going to Michael's point, whether it's full service hotel or full service amenities like a suburban home, the more attractive that becomes.
Well, gentlemen, at this time, I want to thank our participants for session 1 questions. We're going to get ourselves geared up for our session 2. I want to once again thank our presenters for taking the time out of our schedule. It was very informative for me. I'm going to put you guys on the books for some future webinars and future training seminars here today. And once again, thank you again for your participation. And we're going to start our session.
Thank you.
Happy to be here.
Thank you, guys. Appreciate it.
And on behalf of the NJRA, we would like to thank everyone today. Great job. We just look forward to probably doing this in another 90 to 120 days, because as we know, the real estate market trends are changing, and we need for our marketplace to be aware of what's going on. So on behalf of the NJRA, on behalf of our President and CEO, Leslie Anderson, we thank you for today. Have a good day. Good morning, everyone.
Hello.
How's everybody doing?
Morning.
Good, good.
Hi, Neela. Hi, Dan. Hi, Tom. How are you? If you don't know me, I'm Darrell Godfrey, the COO of the New Jersey Redevelopment Authority. And thank you for joining us today. And we're going to have a very lively discussion as usual. We just got off one, and we're starting another one. And that one was very engaging. So what we like to do here is I'll just give a little brief illustration of who I am, and then we'll go from there. So once again, Darrell Godfrey, from Chief Operating Officer for the New Jersey Redevelopment Authority. And we here at the authority just do two important things. One is provide educational opportunities to developers, realtors, lawyers, or anyone who's interested in the real estate market. But what we mostly do here at the NJRA is really provide financing. We are a small finance organization authority run by the state of New Jersey, and we provide really two important sources of funding. One is our USA Urban Site Acquisition Loan, and the second is our Redevelopment Investment Fund. And both of those funds are really geared to help small businesses really get started. We have a phrase that we use, we're there first. And what we mean by that, we like to put the shovel in the ground, but more importantly, what we like to do is help the person really get started into the 67 urban areas that we provide financing to. So on that, that's a 2 minutes brief illustration of what we do here at the NJRA. I've been with the organization for 7 years. I'm a banker. Some people consider me very boring because I'm a banker, but that's what I do. I'm a finance guy.
I love you, Darrell.
Thank you. But I'll just stop right there, and we'll start with everyone giving a brief introduction of what they do. We'll start with you, Neela.
Great. Well, thank you very much, and thanks for having me today. I'm Neela Martin, Senior Vice President at CREA. We're a national tax credit syndicator, having raised almost $8 billion of equity to date. I primarily cover originations in New Jersey and New York, as well as other states around the country. We invest in federal and state tax credits through both proprietary and multi-investor funds. We placed about $1 billion of equity in 2020, and we're on track to close about $1.2 billion for 2021 in just a few short weeks. And I've been with the organization for a little over 5 years now. Thank you.
Tom. We can't hear you, Tom. Something's wrong. I think you have your mute button on, Tom. You have your mute button on, Tom. Venetia, could you somehow change that for him? Because he still has it on. Okay, what we'll do, we'll let Tom figure out some technical issues. Dan, we'll go to you.
Yeah, absolutely. My name is Dan Alger. I'm a managing director and co-head of the Urban Investment Group here at Goldman Sachs. Our group was founded about 20 years ago as an impact investing platform to invest in projects that are, promoting economic development and supporting low and moderate income families, communities, and small businesses. This year, we'll deploy about $3 billion across joint venture equity, tax credits, and debt. And we'll invest across asset classes. Probably 90% of what we do is in real estate. Or fairly agnostic. The type of real estate. The key for us is really being able to connect the dots between the dollars that we're investing and positive outcomes in communities.
Thank you, Dan. Appreciate it. Tom, I think we cleared up the technical issues.
I hope. Give me a thumbs up or let me know if you can hear me.
I can hear you. Yes.
All right, beautiful. So hi guys, sorry for the interruption. My name is Tom Slater, and I am the Senior Credit Officer for Commercial Real Estate at Investors Bank. I am very happy to be with all of you today, despite being Craig Sawyer's, I think, 5th or 6th in order of preference. I'm happy to join you today. So Craig actually asked me to spend a few minutes, and he cautioned me no more than 5, giving you the commercial banker's perspective and touching really briefly on the asset classes that we lend into, and specifically how we qualify those opportunities and how those parameters might have changed throughout the pandemic. So this is really going to be the lightning round when I get into it. But Daryl, you had mentioned that you're a banker, and I think you might have described yourself as a little bit nerdy, which is exactly how I just describe myself too. And us nerdy types tend to attract each other, and we talk frequently. So the comments I'm going to give you are kind of a mix of what I'm seeing and hearing in the market myself, as well as what I'm hearing from my peers at other banks. All right, so here we go. I'm going to start with what I think is the easiest asset class first, multifamily. Not recession proof, but I think a lot of people would agree that it's recession resistant. The space is incredibly competitive. I'd say during the height of the pandemic in 2020, fewer assets traded hands, but the refinance business just really didn't slow up. One change during the height of the pandemic is we were able to get some structural elements that we just wouldn't have obtained in the past. And those were typically some level of personal guarantee or a debt service reserve to help protect against collection issues. In some cases, a combination of the two, but I'll tell you, by March of this year, it just seemed to be business as usual. And with the vaccine rollout and the easing of business restrictions, we were really just off to the races. So, what would you expect from a commercial banker if you're looking to finance this type of asset? From a commercial bank, you'd probably get a term of up to 12 years. You'd get a comfortable 30-year amortization in some cases with an extended period of IO on the front end. And on a purchase, you'd get financing of up to 75%, and probably something less than that for cash out refinance. In terms of what kind of debt service coverage or strength of cash flow you'd need, you'd probably be sized to roughly a 1.3 coverage, which is just a little bit more stringent, 5 to 10 basis points, depending on which lender you talk to, a little more stringent than it was pre-pandemic. So if anyone wouldn't mind, just give me a high sign or a shout so I know that you can still hear me.
You're good.
All right, thank you. I was afraid I dropped it again. Okay, so next asset class, industrial. Warehouse distribution in particular. It was really hot before, during, and after the worst of the pandemic. We love those opportunities, but smaller banks find it a challenge to compete on rate and structure. You'd probably be looking at about 70% loan to value on a purchase, and maybe a sliver of recourse. So it's tough to get in this space, but driven by quality of tenancy and rollover risk. The next asset class I'll comment on briefly is retail. So that can be a little bit challenging yet, and I'd say most lenders are still pretty selective. What I hear as an attractive type of asset is your grocery anchored neighborhood centers kind of stand out. Now, unlike multifamily, the availability of capital for these assets hasn't fully recovered yet, and in a lot of cases you're still able to obtain some level of recourse. And in terms of debt service coverage, we're looking for a greater margin of protection than we would have pre-pandemic. So if you're a developer of that type of asset or an investor in that space, and you're talking to a commercial bank, that conversation is probably going to start with a debt service coverage of around 1.5 times. Next space is office, and this is tough. It's almost toxic. Both our approach and what I'm hearing from my friends at other New Jersey-based institutions, many of which are not entertaining new requests in this space. We're being highly selective. So we happen to have done a handful of larger deals over the last year and a half, and we've pretty much limited them to superior quality assets in a superior location. We underwrite to a higher degree or higher margin of protection than we would have before. Most of it, we expect to see further compression in rents. The last stat I saw on this as it relates to Jersey is right now about 9 million square feet of office space is available in northern New Jersey. So that in terms of percentage, I think that's just north of 25%, and I don't remember it being quite at that level since like 2009, 2010. Right. So in the last recession we saw, or in the portfolio I work with, saw some users trade up. They were still able to pay the bills, and for what had been their existing rent when they got to their lease expiry, they're able to go for the better quality building or the better location. So aside from being kind of choosy and lending into superior quality asset and superior location, most folks I talk to seem to think that medical office, particularly in close proximity to healthcare centers, as well as life sciences, those are other bright spots in that difficult space. I'm going to give you one more asset class, and then I'll talk really briefly about construction. Hospitality, hotels in particular, it's almost impossible to find bank financing for right now. I've worked on one in the last year, and we held our breath when we did it, but it was structured really tightly, and our sponsor was facing a maturity at another institution, and he had to come out of pocket with 2 years of payments to fund into a debt service reserve for us to consider doing the deal. And my last 60 seconds I'll spend on construction lending. So the majority of projects I work with are multifamily. We do a handful for sale, which most of those are condo. We are, post-pandemic, we are definitely more conservative on the loan to cost and the underwritten debt service coverage than we used to be. We routinely go as high as 80% loan to cost before the pandemic, and that is a little aggressive for banks. I don't know if anyone else was lending that much into projects. Nowadays we're probably closer to 70% on average, and lower when we can be. We'll scrutinize that project budget even more closely than we did before. One thing we're not doing now, though, is we're not going to water down the hard cost contingency in order to win a deal. So I'm sure everybody on the call is familiar with supply chain disruption and rising material costs. And so we're kind of starting that hard cost contingency discussion at 10% of the hard cost budget, and in some cases more. Interestingly enough, just by coincidence, at committee yesterday, we had a large redevelopment deal come back for approval and for an increase, and it's something that we had approved, 2, maybe 3 months ago, and the reason it was back to decision and to consider in a larger loan amount was over the course of time that roughly 3 months that had elapsed, the materials costs increased about 14%. So that's one very real way in which this inflation and supply disruption is presenting itself to us. So in closing my comments on construction before I throw it back to Daryl, that activity without question is the riskiest lending activity that we engage in, and so we're making decisions based on what we can observe in the market today for assets that aren't going to be ready to lease or sell for another 2 or 3 years. And when those projects get into trouble, they really punch above their weight. For anybody who's listening, who's developing property and searching for construction financing, it's also probably the toughest type of loan to qualify for, because it's difficult for bankers who are pretty conservative lot, because out of every dollar we lend, maybe a dime is ours and the rest belongs to our depositors. It's hard to get comfortable with a project if the people behind it aren't experienced and don't have a record of success. So that's Donna. Thanks for letting me abuse your ears for 5 minutes, and I'm going to give it back to our moderator, Daryl.
Tom, thank you. You really continue to enlighten me what's going on in the marketplace. Right now, we'd like to turn it over to Neela to give us a brief understanding what's going on in her marketplace.
Great, thank you. All right. So on November 19th, the House passed the Build Back Better bill, and according to Novogradac, the provisions within the bill could finance nearly 812,000 additional affordable homes over the next decade by investing nearly $12 billion in the housing credit. If passed, the industry would grow by approximately $8 billion, and this would be achieved by lowering the bond financing threshold from 50% to 25% for 5 years from 2022 to 2026, increasing the annual housing credit allocation at a rate of 10% per year from 2022 to 2024, followed by inflation adjustments after 2025, providing a permanent 50% basis boost for properties serving extremely low-income housing, and other measures. If passed, the affordable industry would face changes for 2022. Increased equity demand would occur mainly from additional 4% transactions, but of course from the other provisions potentially in the bill. The question really becomes, how do we support the additional $8 billion of equity need with the current investors? Fannie and Freddie have both increased equity caps, but there will be a need to attract new institutions outside of banks. And how do we do this? Typically, our equity funds are split between 9% and 4% deals, about 50% each. But with an increase to the 4% market, our funds could potentially be overweighted with bond deals, which have a higher leverage risk. As a syndicator, we need to manage how we balance our funds so that we can place these deals and not create concerns for our investors. What this means for the developer community is, states will be able to fund more deals by spreading volume cap over more transactions, and additional 9% credits will help fill gaps. But this will create more supply. So there will potentially be lower equity pricing next year when there are more deals, especially bond deals. We're going to have to find ways to lower the leverage, and doing so will make 4% deals look more like 9% deals, which will help to balance out our funds and allow for more syndicators to sell. If possible, sponsors will need to seek subsidy to reduce debt to offset the leverage on the 4% deals. And we are seeing some states using their state tax credits to accomplish this. In terms of trends in the market for next year, there really still is a focus on 9% product with really repeat sponsors. Having that relationship is really important as we're moving forward into next year. Impact investments. What renewable aspects are being incorporated into the project, such as solar panels, better insulation, certifications such as Passive House and Net Zero. Projects that deliver sustainability will be sought after. ESG initiatives have refocused what investors are looking for, and in some cases, who they want to do business with. There is significant momentum in the market through ESG funds with specific targets. Investors want to know that their investment is having an impact to at-risk communities. Investors are also evaluating services, especially holistic initiatives for the tenant. Is there Wi-Fi throughout the property? Employment training support, programming that supports economic and social advancement, case management. There are ways investors can help with these initiatives through fund training programs and fund vaccination clinics for properties. Mixed income, while still not the most attractive product for investors, given the perception of risk of market rate rents and the percentage of affordable units in the property, there is an industry push to finance more of these deals. Average income was an important step for mixed income deals, but with current investor concerns on the cliff event of the affordability test, this has been a tough sell. And lastly, investors' comfort with Section 8 has changed since COVID. We used to have many discussions around whether or not Section 8 would continue to be funded, and investors are now seeing this as a positive as it relates to economic occupancy.
Thank you, Neela. Thank you very much. Now, Dan.
Hi, can you see me? Hi, Daryl, can you hear me?
I can hear you, but I can't see you, Dan.
Oh, no. All right, maybe in the interest of time, Daryl, maybe I'll just run through this, and then once I sort of walk through this, I can try to relog in again for the Q&A.
Okay.
Yeah, just a few observations on the capital markets. Try not to be too redundant with what the other panelists have talked about already. The first I'd say is the availability of capital. There is obviously a very significant amount of capital that is looking for equity and debt investments in real estate. We've seen this throughout the year, and we expect this to continue into next year, and that's created opportunities for development partners to negotiate incrementally better terms on both equity and debt. And if you're looking for stabilized permanent financing, this is a fairly attractive time to put that on your project. We've definitely seen that there are still the haves and have-nots when it comes to how and where this capital is looking to be deployed. Industrial, residential, life sciences are all still very much in vogue, as are high growth markets, mostly in the Sun Belt. But we've definitely seen resurgence here in the New York and New Jersey area. Banks that were once sort of redlining New York and New Jersey through the pandemic have certainly stepped back into the market. But the biggest trend from my perspective is ESG, and I'm sure there's probably not much of a surprise there. But the extent of the focus on ESG really can't be overstated. I think this is the largest one-way trend of our lifetime. I think there is a 0% chance that we look back 10 years from now and say, hey, remember that ESG fad? If we do, it'll be because the components of ESG are fully integrated into standard operating procedures. To date, the primary focus within ESG has been the E, over 80% of investors, today consider, the E and ESG, prior to making an investment. 52% are doing that for, risk management purposes, and 48 are doing it because they, believe that, there's, tenant demand for that product, and will, positively position, them in the market. But we're seeing many more investors increasingly focus on diversity, equity, and inclusion. And to be honest, it's hard to overstate this as well, and sort of how quickly it's evolved over the last 18 months. We're having conversations with corporations really across the spectrum, from pension funds to insurance companies to healthcare networks. Anyone who is sort of a traditional institutional investor is thinking about, and we're having conversation with almost on a weekly basis at this point about how they can deploy capital to support racial equity. And then the last trend that I'd note is really thinking about real estate differently. So thinking about real estate less as four walls and a roof, and really thinking about other possibilities. There's a ton of focus from the technology sector and prop tech, and something that we're particularly focused on is the provision of services, particularly just how well it fits with the mandate of our group. And there are different sort of technology-based services like credit reporting and telehealth, low cost access to Wi-Fi, and these things have not previously been available and are today. And the real estate can be a fantastic delivery mechanism. But then there are other types of services that we're working on that require partners. And having after school daycare, financial literacy, various sort of health programs available and delivered on site. I really do think this is sort of a white space for the industry. Maybe I'll leave it there for now.
Dan, thank you for that. Sorry for the little technical difficulties there, but I was just impressed to hear about equity and inclusion, particularly how it relates to the NJRA. That's what the NJRA primary emphasis is for equity and inclusion, but also keeping abreast to the market trends and what's going out there. The NJRA had to pivot this year, primarily because we saw such a hemorrhage with our small businesses, but we wanted to keep them in business. And how we did that is providing them with small grants to help them, the mom and pop store, keep in business. Because as we know, without Main Street in America, we're not going to be able to thrive. And so we offered grants up to, I think in the marketplace, we have around $17 million out there to various mom and pop stores to keep them in business, to help stabilize the real estate market. Because as we know, it's hemorrhaging right now. On the commercial side, it's hemorrhaging. But the interesting part, we see an uptick on the residential real estate side. So, I mean, one thing goes down and one thing goes up. But at the state, what we're trying to do is be a buffer to try to help stabilize the marketplace. So at this point, I would like to send this over to Oscar Parham, and he will have some questions.
Wonderful. Thank you, Daryl, Tom, Neely, Dan. Thank you again for your participation. But I've got some very powerful questions to ask you. So I'm going to start off with one of the chat questions that I thought was very interesting. The question is, recently, a leading mortgage lender accepted cryptocurrencies as a home loan payment. Should we expect this to increase in 2022 as a form of currency? And what opportunities and challenges does this present to small businesses and developers, if any? Any thoughts on crypto? Dan, do you have any?
Tom, I think you're on mute.
Oh,
And we have not. It's a really interesting question. We have not. We've not, bumped up against this issue to date. Obviously, a big focus on crypto. I'm curious to kind of see where it goes and how it's rolled out in a way that can really create more of an inclusive environment and access to capital and financial services for those that are underserved. I think we have a long way to go to see that fulfilled.
wonderful. Thank you, Dan. I've got another question here for our group. Do you foresee the Opportunity Zone program gaining momentum as an important funding source for developers and small businesses in 2022?
I can speak to opportunity zones.
Thank you, Dan.
We've seen a lot of interest on the investor side from folks who have had capital gains this year. Obviously, the stock market's been up and asset values are up generally, and so there are certainly capital gains. And we've seen that, particularly from high net worth individuals, institutions, and family offices. I do expect that to continue into 2022. We primarily see the focus on real estate assets. I do think that there's an opportunity on the small business side. I think the way the program has been set up and the way it's kind of structured, it can be difficult for on the business side. And I think we all had hopes that we'd see more action on that and a sort of a better sort of investment sort of landscape and structures for small businesses. We haven't, I don't think the program, to be honest, facilitates that very well. I think in certain circumstances it actually does work well. But for third-party investors looking to deploy, fairly significant capital gains, it can be difficult. I do think opportunity zones, it's a sort of double-edged sword, as we all know, right? I think that it can be in a fantastic way to sort of fill a gap. And by that, I mean sort of make a project that's important and impactful, good for the community, that just doesn't have the economics that support, to make it financeable. It can sort of close that gap and allow those projects to move forward. And that's fantastic. But we also know that there are, plenty of projects out there that are not consistent with, I think, the way, we had, many of us had conceived of opportunity zones and the way they're supposed to impact local communities. And so I think we, really need to be thoughtful around it. And we've certainly put, structures around, our investments and parameters that go above and beyond just the legislation itself.
Wonderful. Thank you. Appreciate that. I see I got another one here. I've got.
I'm happy to answer a few.
Okay.
So I think with the opportunity zones, Korea closed on a few transactions this year. It on a limited basis, primarily with some insurance companies that we work with. I think that it's going into next year will just be on need and demand of our investors if they've inquired. For the deals that do get done though, it'll be interesting also for the state agencies to get involved. They're having deals with projects that are put into opportunity zone funds, right? Because the deals are different with the equity really coming in up front, which changes the structure of the transaction. But good for the agencies to get involved with those as well.
Gotcha. Appreciate that. Let's see what else we have here. We have, here's another question. With inflation and possible higher mortgage rates, what impact will this have on financing of rental and for sale housing development in New Jersey?
So I think the interest rate part of the question isn't that difficult to predict or speak to. So, if rates increase, then obviously a given level of cash flow will support less debt, which means that, developers or investors, in that space, and I think you're talking about multifamily in particular, potentially have to put more equity into their projects. The other impact can be the influence of interest rates on cap rates, and and that has a direct impact on the value and qualifying for loans. So if in general terms, if if the question was really focused on, what would you expect to happen in a period of increasing interest rates, activity will slow to some degree. I think that's the obvious answer, the easy answer.
I've got another good question here. Let's see. Have real estate syndicator requirements for equity capital, has it changed as a result of the pandemic? And if so, what are those changes?
I can start with a few points.
Thank you, Neil.
I think that there have been many changes. Some of the negotiated business terms that maybe have been pre-pandemic have changed. Stronger business terms have been put back into deals. One thing we're seeing a lot of investors pushing back on and requiring is security during construction. It's really more of a focus right now in all areas of real estate, especially even with related party sponsors where they're the developer as well as the general contractor. So, we're requiring, the 100% payment performance bonds or 15% letter of credit. And really there's no movement off of that. Having gone through what we just did, there's supply chain issues, delays in construction. We want to see that security there. So I think that's been a change. With that delay in construction, labor shortages, we're really still adding in that COVID buffer. So about an additional 3 months to the construction timeline that we're presented in the contract, adding that 3 months because, some of these transactions do need it. Really trying to avoid delayed credits and adjusters on the back end.
Gotcha. And here's and I think Dan, you spoke a little bit about this. I've got a question. With Goldman Sachs and other firms seeking to bridge racial inequities, how should small minority businesses or developers best be prepared for the opportunities for inclusion and equity?
Well, that's a great question. Honestly, I think now it's like strike while the iron is hot. I mean, if you move now, as I talked about, ESG, and I do think, the one-way trend, and we're not going back. But I do think, and when we talk about racial equity, I hope that this is not a moment in time. But I think the best way that we make it not a moment in time where this is focused is by just doing more within this space and sort of and having it become institutionalized. And so the more that we can do, the more that we do now, the more that smaller development partners will form relationships with governments, investors, bankers, and as we all know that those relationships are so important. Often when you're working with a larger institution, getting over the finish line and doing that first deal can be critical. And then once you're sort of in the flow, it becomes much easier. And so I would hustle right now and reach out to banks, and I would do it earlier than later. Getting involved even early on, just sort of planting the seed. Hey, this is what I'm working on. Touching back, giving folks updates along the way. You create a rapport. You create a familiarity. You get people get to know you, get to understand sort of how you view the world, how you sort of pull something together. And I think even if that happens over like a 6-month period, I think it's much more impactful than even just sort of presenting something and saying here's what we got. Here's this is ready to go. It seems very sort of like abrupt, but if you're on the radar, you get folks excited about it. It could be in the future, and then you give folks, updates along the way. I think that can be powerful and effective.
Oh, thank you, Dan. And Neela.
Sorry.
Oh, go ahead, Neela.
No, I couldn't agree with you more. You're right. That first deal is always kind of the hardest, and there's a lot of diligence and review, but have patience while you work through that because it will lead to more opportunities and ease as you move forward. maintaining communications with your current financing partners and starting new relationships. You need to have a group that can help you, because not everyone can sell the same product. You're going to have different deals and transactions, and placing them, with a proper outlet. Have those relationships, have those conversations, find out what's going on in the market. Selling what you have. What benefits are you bringing to the investment? With keeping in mind, these ESG goals, sustainability, as we move forward into 2022 and beyond.
Thank you. And one last question is, like I say, all things your network, importance of your network and relationships. I'm hearing that as a central theme here. One last question for our group today. It's interesting. What business opportunities may result from the infrastructure bill, especially as it relates to business and real estate development opportunities in New Jersey?
One of the things that we are, particularly focused on and excited about, the infrastructure bill is early childhood education. I know it's, it's a specific area, but that is obviously, we all know that is absolutely critical. There aren't enough resources, today to really sort of, build out those types of businesses as they really, need to be to support particularly low-income communities. And I understand the bill is, has some focus on that. That is something that we absolutely, have been focused on, but would love to do more and are really excited about that.
Any other thoughts, Neela?
Yeah, just in terms of, development opportunity, if the provisions do pass, says, there'll be an additional, more 9% credits flowing into the marketplace, an ability for the volume cap to be spread amongst more transactions. And it's going to give you more opportunity to kind of hopefully fill some of those gaps. What will be interesting is to hear what the state agencies will be doing. Will they be raising their caps on their 9% if there are more credits? How they'll be financing these deals. So I think a conversation with the agencies and hearing what they have to say, will help developers kind of manage and prepare for next year. So they're just more opportunity for supply and deals to get done.
Wonderful. Thank you, Neela. Thank you, Dan. Thank you, Tom. Appreciate you guys. Today, we appreciate our participants for these very insightful questions at the end of the day. And I'm going to turn it over to Mr. Godfrey. If you've got any thoughts you'd like to share with us before we get ready to close this out.
No, just like you, Oscar, I'd like to thank Neela, Dan, and Tom for providing such insight in what's going on in the marketplace, particularly on the financing side. There's a lot out there in the marketplace. We have, from the NJRA side, we're trying to figure it out ourselves, how to handle the marketplace. This COVID has all of us going in such a crazy direction. But one thing I can see that, we hear about inflation, but the marketplace seems to be stable and changing. You see the real estate, you see the Dow Jones still doing very well. And also you see on the residential side, particularly in the Northeast, you see the marketplace is very hot, but you see a downturn on the commercial side. So all of us are pivoting and trying to, really react to the marketplace. Dan, I like to just say, what you said was very interesting about being inclusive. It's true. We need to change this. We don't need to just, say it. We need to be a part of our infrastructure, what we do each and every day as not just people, but as lenders, and try to make it more stabilized, make opportunity for everyone. So on behalf of the NJRA, our president and CEO, Leslie Anderson, Sheila Oliver, our chairwoman, and Governor Murphy, we'd like to say thank you. Everyone have a blessed and safe holiday. And Oscar, your group, RTI, the Redevelopment Training Institute, once again has done a tremendous job. So we thank you. On behalf of our president, CEO, Leslie Anderson. Thank you, Oscar.
Thank you. We've got a quick closing, and I'll let Venetra cue that up.
We're at that time. We're concluding today's webinar. So First of all, I'd like to thank our participants, first of all, because we do this because of you and we're here because of you. So thank you very much for registering and participating in today's webinar. We hope that you left with a better understanding of what's new, keeping in perspective of what we've gone through over the last year and a half in regards to the pandemic. And we hope that we've given you some insights into some opportunities in the real estate market. I'd like to once again thank our speakers, and I cannot thank them enough for giving up their time today and working with us as well. We will be posting our upcoming webinars for 2022 very soon. We're going to be focused on real estate development as well as our small business community. So look out for our communications via our emails, which I know you love to get, as well as our our social posts. We are going to be doing and presenting to our community some very innovative strategies for delivering our content and education for 2022. So look out for that. And we also at this time, we want to thank our ongoing partnerships with various government agencies, specifically NJDCA, NJEDA, and HMFA, along with the New Jersey small business community, our real estate industry experts, as well as our community leaders and organizations. We can't thank you enough for collaborating and working with us, and we look forward to strengthening that relationship as we go forward for 2022. Thank you for participating again today and sharing your feedback, which gives us insight into where we need to be to meet your needs from an educational resource standpoint. So I'm Oscar Parham at the NJRA, wishing everyone who participated today all the best.